everyone. Thanks for joining us today. We've got, we might just wait another minute to let more people join, but you've got an amazing team today of capital raising experts and a very experienced, diverse team. So we're going to be talking about Giant Warm Intro. And if you've already applied, you'll get some information around it, or maybe you're thinking about applying. Hopefully we can answer some questions for you there. And we're going to go through some topics like what kind of capital is appropriate to raise, when should you be thinking about raising capital for your business, and you're going to hear some firsthand stories about capital raising, both angel investment and seed stage. So we'll just give a few more minutes for everyone to arrive. Let's do it. So hi, everyone. I'm Sarah Gibbins. I work at Rampersand, which is a seed fund, Australian venture capital seed fund. So we have 100 million under management. We're on our fourth fund, which is a $50 million fund. So we've got about 30 startups in our portfolio, and we only invest at the seed stage. We do some follow-on, but it's mainly a seed fund. So very specific to where a lot of you will be thinking about, which is sort of at that earlier stage. Today, we've got a panel to talk to you about different kinds of capital, to talk about Giant Warm Intro, which is a program that we've been running now for a couple of years that's designed to make sure that every tech founder in Australia has access to a warm introduction to an investor. It was started about 4 years ago as a reaction to the lack of capital that women and underrepresented founders were receiving in the ecosystem. Those numbers are still pretty low, but there's a lot of different initiatives working to change that, and Giant Warm Intro is one of them. We welcome all tech founders who are at pre-seed, so that haven't received seed stage capital. We'll talk about what seed stage capital is. And we especially welcome women and other underrepresented groups. So this year, we've already got about 150 founders who have applied, and we have right now, I think, 100 investors who have signed up to meet with those founders on August 24th. So applications close on August 4th, and then we'll let the cohort who have got in know shortly after that. So I will kick off with today's content. We've got a really amazing, really experienced panel. We've got Jason Atkins from Cake. So he's co-founder of Cake, and Rampersand is actually an investor in Cake. So we know Jason really well. We've got Lauren Capelin, who works for startups at AWS. So she has been around the VC and startup ecosystem for a very long time. She is a great person to talk to if you have a startup and you're thinking about raising capital, and you need to know what kind of events to go to or how to get further into the ecosystem. Lauren is a gun there. We've got Sarah Agbool, who is a founder herself, and she also participated in Giant Warm Intro and has experience raising angel capital. So her experience today, I'm really excited to talk to you, Sarah, about what Giant Warm Intro was like for you and what it's like being a founder raising angel capital. We've got Cheryl Mack, who is the CEO and founder of Aussie Angels, which is one of the most sort of prolific angel investment groups in Australia. So you've got some heavy hitters here who are really excited to talk to you guys today and try and break down some of the mystery around raising capital for your tech startup, and bringing down kind of some of the barriers that you feel might exist around accessing capital. So to kick off, the way that today is going to run is a bit of an interview style. I'm going to ask each participant a couple of questions around areas that they're really passionate. If you have any questions, put them in the chat there, and I'll try and get to them, especially around jargon. So we were talking about this in the briefing call, and I was using all this industry jargon. And we sort of realized, hey, let's break down the jargon. And sometimes it just slips in. So if there's, a word we're using, like, make sure you know what your moat is, and you say, what the hell is a moat? We can bring that up and ask the panelists here too. So don't be shy. The whole point of this is that you get to ask questions around raising capital that, sort of a shortcut in, and maybe to help you understand whether or not you should be applying for Giant Warm Intro. So let's start. So Jason, we're going to start with Jason today. There's a couple of questions I want to ask him. One of them is, how do you know when it's time to raise capital? Or actually, we're going to start with Lauren, weren't we? I've jumbled up the mix. No, we're going to start with Lauren, sorry, because it does flow on. So Lauren's going to talk about today the different kinds of capital that are available to startup founders, because I think that is one of the most important things to understand, that there's different ways to get money to help you grow your business. And some of them, are a bank loan, or, as we said, like, do we want to explain everything, like credit card from the ATM all the way through to venture capital? So Lauren, why don't you kick off and just give us a bit of an overview of some of the different kinds of capital that would be available today in Australia to tech founders?
Sure. Thank you, Sarah. And in fairness to you, I guess most founders would be like, it's time to raise capital, and then think about what they need to raise. So I think that's also a fair way to ask the question. But I think what I have seen over my time in startups, you did say that I've been around a little bit of time. There have been different waves of, the role of venture capital, the presence of venture capital in the first place. And probably what's happened over the last 10 years is the gravity has swung in the direction of VC. But it really is worth taking a step back and remembering the way to fund, to build a business, to build a credible business. So I really think it's looking at the fundamentals of what you need the money for, and that really determines the pathway that you take. But as you started talking about there, the very first place a founder should start is, what can we do for as little as possible? The idea in those first, few weeks, few months is to spend basically nothing building your business and proving out those assumptions. And that's the benefit of the fact that the cost of building a startup has come down so significantly over the last decade through things like no-code, low-code tools more recently, but even just, shared services like, AWS, where that cost can actually be distributed amongst startups and centralized by one organization. So cost has come down, and we don't need to raise the kind of capital that perhaps founders in the early tens needed to. So once you feel like you have proven out this assumption, I think there is a process where you need to figure out where to pour fuel on the fire. But even at this stage, it's not about raising the millions at that point and not knowing how or where to spend that money, because that's really the worst thing that you can do. You need to be testing each thing individually and figuring out where you're going to get that exponential growth. So, for founders to start thinking about whether or not they can build a business sustainably through the revenue that they can get from customers, that's kind of pathway number one. They may be able to self-capitalize all the way to whatever outcome they think is useful. They may sit in the middle where they need a little bit of a kickstart to accelerate growth in the early days until they reach a point of momentum. And for founders in that middle bucket, I think things like accelerators or grant funding, perhaps lines of credit. Each of these types of funding do come with different strings or different obligations. So it's worth looking into those things. But for the most part, you can give away a very small amount of your business for some upfront capital, or it's non-dilutive, which means that you don't have to give away any ownership, and maybe you're just paying some kind of interest, fee on the amount borrowed. Moving closer to the actual funding end of the spectrum is where you can consider models like equity crowdfunding, which isn't for the faint-hearted. It's almost as challenging as raising a round in many ways, because you have many investors. It's usually suitable for direct-to-consumer type models or consumer-facing products. But we are seeing great success through the likes of Virtual with B2B, business-to-business oriented platforms where customers essentially can become owners of that business. And then you're moving into the angel up to venture capital equity funding at those later stages. But at those later stages, you are signing up for a much longer trajectory, a 10-year time horizon and an exponential growth of the value of the business that you're building. And you have to be really clear at that point that that's the journey that you want to go on. And I'm sure we'll dive into that in more detail.
I've just got a question from Michael who says, is it usually better to bootstrap as long as possible and demonstrate traction before looking for funding to grow? Or is it better to get earlier funding to go faster earlier? Good question.
Michael, do you want the 2023 answer or the 2018 answer? I think the reality is that probably the answer should have stayed the same the whole time. And I think unless you have ultimate clarity about where you're going to deploy the capital you're raising, maybe bootstrapping isn't always the best word for it. It's how long can you fuel the growth of the business? Bootstrapping almost suggests a different trajectory entirely, where you're always going to be running on the smell of an oily rag. But I think it's really, what are the milestones you get to before that outside funding, that outside capital is ultimately make or break for your business. You'll plateau or you'll just boom from there. But yes, in today's market, it would be extremely difficult to raise without that level of traction, and money does not make your business grow faster. The reality is the things you do to your business make it grow faster. The money can help you do it at scale or build out a certain, team. One mistake that I see so many early stage companies making when they raise funding is thinking that they're deploying it to, advertising and marketing. We're just going to put people on the problem. But if you don't have an existing flywheel that you're powering, those things are not sustaining kind of ways to build the business. So that's where waiting longer till you have that metric figured out, or that sort of, the flywheel of your business figured out, is a much more compelling case for investment.
Thanks, Lauren. It's also, I would add, if you think about it, it just gets you in a stronger position for a better deal. So if you want to get the best kind of deal, from a VC, and you want to be in a really strong position to negotiate, the further you are along proving out your thesis of an idea, the better it's going to be for you. Thanks, Lauren. We've also had a question from Andrew here, which I think will be answered when we talk to Jason. So I'll just read it out and then we'll keep talking. And then Andrew, if it's not answered, you can come back to me and I will. He says, I'd like to understand what typically constitutes an equity stake during a seed investment round. And additionally, what are the common prerequisites or conditions a startup should meet before you consider investing? So we're going to talk about, now I'm going to move across to Jason and ask him to talk to him about two things. One of them is, how do I know when it's time to raise, which is, at seed stage, what milestones do I need to hit, or at pre-seed? And the other one is, I'm going to have Jason, after he sort of talks about that a little bit, give his insights into what it was like raising capital himself. Cake Equity, actually, apart from being in the Rampersand portfolio, which we're incredibly proud of, did a deal with Jason Calacanis. And if you don't know who he is, he's sort of the most prolific angel investor in the world, really. He runs the All In podcast. He's part of that crew in Silicon Valley. One of the book recommendations I have for the end is his angel book here, which just gives you an overview of angel investing. So I thought that was pretty cool when I found that out, when Jason and Kim, his co-founder, told me that Jason was one of their Calacanis was one of their investors. So I'd love to know about the reality of taking angel investment from him. And then later we're going to talk to Cheryl here on the panel about what it's like to take angel investment from her. So, which I would argue.
Should we start with that? Should we start with that story? Well, first of all, I'd also like to say Lauren led Kate getting into StartMate, who were also on our cap table. And Cheryl, I think, was just about our first ever investor and has invested in us maybe twice. And we ran part of our last round on the Aussie Angels platform. And I think I've pitched every second angel in Australia. So I have plenty of experience with that. So look, the Jason Calacanis story is a pretty fun one. It's actually great to be reminded of that. So thanks, Sarah. I think we helped make him more famous. I think he's more famous now than he was when he invested in us, even off the back of the All In and everything else he's doing. But yeah, so the moment was pretty wild, but it all stemmed from getting into StartMate. And I think any of you that are looking, very early and you want to learn fast, I'm a huge advocate for high quality accelerators. I think, there's just so much you have to learn as an early stage founder, and accelerators are tremendous for helping you learn a lot, raising your ambition. You know, I don't want to like trash anybody else, but I think StartMate's the best one. So we're in Australia, we were so proud to get in there. That was a huge achievement for us. But then we knew that was the beginning of the hard work. And so we worked like extremely hard during that accelerator to hit our goals every week. And by the time we got to the end of the accelerator, you're just right in the box seat to raise a round, you know, because everybody's kind of looking there as if to say, all right, well, who's smashing it? So we're very grateful for that. We're in a really good situation. We're talking to a bunch of Aussie VCs, and like JCal, as we call him now because we're friends. We're not really, but I can chat to him on Slack. But he posted something on Twitter about like, is there a competitor to this big like multi-billion-dollar, you know, US cake? And we hustled in the thread, and StartMate helped us hustle in the thread. And one of the StartMate mentors, actually, Kate Dinham, was the one that told me about the thread. So it's all this community thing. And then it turned out that Dean McAvoy, who was advising us, which is another StartMate mentor that I hustled into our team around that time, he had Jason's email address, and then we had a couple of emails, and then we got him on a call. And it was a 15-minute call, so I wasn't expecting much. And by the 10th minute, I shouldn't tell this story like too publicly. I don't know if he's going to be upset at me, but like by the 10th minute, he's like, right, I'm leading around $1 million. And I was just like, whoa. And then like a minute later, he goes, right, make it 2, but you have to accept by tomorrow. So I got off the call and just called my co-founder, and I'm like, what just happened? That's crazy. So yeah, we're pretty pumped about that. Huge. So he led our seed round. That was our first seed round. We've done heaps of rounds. Been embarrassing. It's hard to raise money. It's hard to scale globally. So just being honest, like we've raised a few rounds. We're doing extremely well, but we have raised a few rounds. So hard to get a global fintech Series A done. And then our last round was in the middle of the bloodbath last year. So even though we were growing ridiculous and achieving our goals like crazy, we had to take a much more painful round last year, like everybody else did. But we were still extremely happy with the round we did, and the support we got from Rampersand was wonderful. I think Aussie Angels came in on that round. So we still did an awesome round that we're very, very happy with, but it was nothing like the frivolity of the year or two earlier. So that's just a little bit about, you know, a bit of capital raising story. Hopefully that's interesting for you all. Let's dig into how to know when you raise. Is that okay, Sarah? We'll do a little bit of that.
Yeah,
I've got a couple of slides.
How to know when it's time to raise. There's also another question that I think I might kick to Cheryl later, which has come through from Tristan, saying safe note cons in relation to early stage. Hold on, it just disappeared. Early stage investor types in Australia. So the pro and cons of safe notes. I think Cheryl might be able to take that later. Do you think that would be all right, Cheryl? Yeah. So I'll try
happy to
when we get to that. So for now, let's kick off, Jason. How do we know when it's time to raise?
Sweet. So look, I've broken one of my main rules here, lots of words on a slide. I know you shouldn't do that, but I wanted this to be a takeaway, maybe take a screenshot, or plus I didn't know how else I could communicate this much information. So do apologize for that. So pre-seed, use of funds. So it's to build your MVP. So if you can't bootstrap it all the way to seed, if you really need a little bit of funding, you know, I really love what Lauren said about bootstrapping, no coding, going hard early these days. It's never been a better opportunity to do that. As a cap table guy too, it's going to protect your cap table and you're going to get less diluted. So that's another win. You know, it's to help get your first paying customers and validate demand, that sort of thing. I have said excluding hardware there because it's a slightly different sort of capital raising and go-to-market frame quite often for hardware and deep tech. So what do you need to do? So these 6 categories, I think, is a really nice framework for you to think through and try and test yourself on. And as Lauren said earlier, you want to be as strong on each of these 6 things as you possibly can when you raise your pre-seed, because then you're going to get a better value, you're going to have a better chance of success. So on your idea and your mission, is it very clear? Is your mission and your problem and your solution really clear? You know, for a pre-seed stage, of course. And how? So test your mission, pitch, and check it resonates. Like pitch advisors, pitch investors, they should be telling you, hey, this is awesome, this is cool, I get this. On the product side of things, I'll set my timeline so I don't rabbit on too long. On the product side of things, you know, what? So you have to have some sort of prototype or beta. You can't go raise money with nothing. You're going to get told no. We might not get told no, but you're going to really spin your wheels there. So people have to be able to interact with it in some way, whether it be wireframes, whether it be user interviews, whatever. There needs to be something that people can interact with on the product side to be able to raise a pre-seed. On the team side of things, so I've got here what. So why are you awesome? I think it's all about bringing out and being able to articulate clearly why you're awesome. What is the 10 to 100x factor about you and your team in this particular case that sets you apart from everybody else? Highlight that with logos and IP. On strategic relationships, so that's all about partnerships, industry experience, and any customer relationships that you have, and how do you show that. So that's LOIs, support letters, references, and past experience that you can clearly articulate. On the traction side of things, this is pre-seed, so it's very, very early, but you must have some sort of customer proof, not necessarily sales. That could be some manual sales that you've done that might not be, the real way that you want to sell. So you might be doing hand-to-hand, founder-to-founder sales, not full SaaS sales yet, but some sort of sale. It could be some sort of website hit, some advertising testing that you're doing, letters of intent, things like that. So real early stage traction that give investors confidence that you can sell, that you know how to sell, that there is some demand and that you're on your way towards getting some sales. And then the use of funds is a big one. I added that at the last minute. I think quite often early stage founders are not clear what they're going to use the funds for. And so like a simple 12-month plan with money coming in here, money going out there, exactly what you're spending it on, and being really clear what the milestones are you're going to hit, because investors want to know that you know what the milestones are that you need to hit to get your seed round done, because that protects their money. So that's pre-seed. While I've got a couple of minutes left, I'm just going to really quickly touch on seed, because I think this is pre-seed. Some of you might be wondering, are you seed or pre-seed? So let's just quickly touch on that. The use of funds are a little bit later. It should be to iterate and improve an actual MVP. So this isn't beta prototype. This is real MVP that customers can love. They can engage with it. You can retain them, things like that. You need to be able to show, you're looking to show market size during the seed stage, test and learn the scalable channels. So when you get to Series A, you can really invest to scale up. So some of the progression that you need to show if you're at seed, I'll just touch on a few of them. On the product, as I said, MVP, like a real thing that customers can show that they love. And that's like engagement, retention, and feedback type stuff of the actual product. On the team, it's probably pretty similar, but you might be closing some gaps. If the founder has weaknesses, if you've got a single founder, if you've got a couple of like really clear gaps in your team, you want to show that you're closing those gaps. Strategic relationships is just like probably a progression of what I've already talked about. Traction's probably the big differentiator between pre-seed and seed. You're talking real sales, real revenue, real sales data. People are actually showing that they come in, they use it, they engage, and they stay, and they have customer love. That's probably the big differentiator between pre-seed and seed. I think that's it. And then the last thing on like, how do you know you're ready? There is sort of like a capital raising preparation process that you need to go through. I'm just gonna I've made this toolkit that you guys can use, and in this toolkit, I'm just gonna pop it in the chat here for you. Where's the chat? Here it is. You can use this as much as you like, but in here there's a capital raising checklist. And again, sorry, Lauren, I've used some of my lessons from StartMate and various other programs are in here, but learn from the best, right? So I've pulled together all the stuff I've learned over the last 5 years of raising and mentoring into this toolkit. And so in here is a step-by-step guide. And, and I think I've got some stuff in here for Cheryl as well, but so, preparing your cap table, doing your valuation, doing a financial model, getting your short pitch deck, your long pitch deck, getting your data room, choosing is it going to be a safer and equity round. Building your investor list is the one that people normally really neglect. So great that you're here doing this giant warm intro and learning investors and meeting investors and getting them, building relationships with them. So there's a checklist there. You do need to have that checklist pretty largely filled out, as well as, these things we talked about. I would advocate always having an advisor on your side that's done this before, or an investor on your side that's done this before, because what they can then do is say, hey, you're ready. You've done all the work. Let's go. Let's get some funding.
Amazing. Thanks, Jace. That toolkit's amazing. It's all there. So Noah, just before I jump on to Sarah and ask her about her experience with Giant Warm Intro and raising an angel round, I've got Noah with the question of what are the best strategies to identify possible investors. I'm really passionate about this one because it's something that I see play out. I also did some research where I spoke to later stage successful kind of unicorn founders and asked them what they would do differently again when they were raising and what advice they would have for pre-seed founders. So when you're building that list, know that it takes about a year of knowing people before you get investment. So your network is everything. You could hear in Jason's story when he's saying it was on Twitter and someone told me, and this person and that person, they're all his network of people that, you know, you'd probably been out and about and meeting people for a good year or so before securing capital. So that's one thing. You've really got to build your network. There's a lot of in-person events. I recommend them. LinkedIn is fantastic. We're all there on it all the time. But as far as what to look for and what kind of investors are the right for you, there does have to be a good match. So these later stage investors said if they had their time again, they only really cared about a couple of things when it came to matching with investors and having the right investors. The first one and the most important one was relationship chemistry. So they actually got along, that the investor really understood their vision and was excited about it and was ready to back it all the way. And those relationships grew over time, you know, over a decade, and they're still friends with them today. So it's quite personal. So if an investor isn't clicking with you or doesn't really understand your vision, then probably not going to be very helpful on your cap table. And then there's some other nuances in there. But yeah, start building a list today, get out there, start to meet people, talk to other founders. Other founders will tell you what these investors are like as individuals and as funds. So that's just the answer there for Noah. Now, moving straight on to Sarah. So Sarah, tell me about your experience raising angel capital from angels, and then also what it was like participating in Giant Warm Intro, the good and the bad, anything we could improve on.
Yeah, so I mean, actually following on from what you were saying in answer to Noah's question, one of the things that I did probably midway point of my raise that was really helpful was actually just going on LinkedIn and really stalking people, really stalking to see who could actually be a good investor for what I was doing. Because when I first started off my raise, I did what I guess is kind of painted in the media, is like go to the VCs, have those conversations. And it wasn't until I was referred to Giant Warm Intro and was able to have a few more conversations with the VCs there. And they actually gave me the advice of, because at the time I hadn't built the tech of my business, I'd bootstrapped for 4 years and then had reached a point where we had so much demand that I just physically couldn't do it anymore. I needed to actually build out a team, that what would be better for me would be to actually focus on angels. And so one of the big values that I got out of Giant Warm Intro was actually thinking about, all right, what are the things I can think about when having those conversations on a more one-to-one basis with angel investors or high net worth individuals, as opposed to going to VCs. So after those types of conversations, I went online, stalked people on LinkedIn. I went on like the Airtree website. They've got a whole list of different angels you can look at, looked at all the angels there, looked at who they were connected with, and then actually pitched people individually. I said, like, I remember one of my investors had on there that he was a stay-at-home dad for a period, and my company is all about helping parents. So I spoke to him about that, and I acknowledged that, hey, I'm actually not in your space because we're definitely a tech-enabled business, not a pure tech product. However, I think you'll engage with this on the personal level, and this is why I'm still emailing you. So I ended up doing quite a few emails like that. And then my hit rate went really, really high. Like the first half of my raise was like going uphill. The second half was like absolutely pushing the boulder down. And it became, I hesitate to say easy, but it became significantly easier than the first half of what I was doing. And my hit rate as well, when I was emailing people, was actually significantly higher. I think almost everyone, I probably ended up emailing about 20 people. Almost everyone got back to me, even if it was to say no, just because it was quite personal. And then of the conversations I was having, it was in each meeting, I'd have a yes or no, either within the meeting or at least within 24 hours. And I ended up being oversubscribed by taking that approach. The other thing that I did during my raise, which made things a lot easier and helped me open up my networks as well, was there's so many different angel investor programs happening at the moment. If you can get in contact with them and ask if you can be somebody that pitches, because often as part of the course content, they've got to analyze different businesses, they've got to look at different pitch decks. If you can ask to be involved, that's a great way to start meeting angel investors, whether they're going to invest right now or even later in your round. I did that at the UNSW one and ended up getting one of my largest investors on board because they maintained that relationship. And that's almost also like a shorthand way if you haven't got like a huge network to begin with, to almost make it a lot faster, because then you're going in with the authority of the person organizing the angel network. So even if you haven't known them for a long time, just the fact that you've now got this person who's almost vouched for you will help you kind of speed that up if you're worried about the time it will take to build up that network. So those are the things that I wish I had done my raise the other way around. And I started with that because it would have been much faster and much easier. But being able to have those learnings and still having that practice of pitching to VCs and having all those different experiences, I have to say, if I'd be honest with myself, probably I had also had a lot of practice from pitching to those people. So as part of that list of figuring out who are the investors that you actually want on board, I hope this is okay to say, but there may be investors who, you know, maybe they'll be a fit, they would be really great. They might not 100% be for you. Do those first. Save the people you really, really, really want to speak to for last, so that you have that practice. You can start seeing the questions that people are going to ask you and start building up your rubric of how you can answer them. The last thing I'll leave with before I'll stop, because I'm conscious of time as well, is that if you, as you start having those conversations, start making an FAQ list of the questions that people ask. I actually had one on a Trello board that I linked to investors. So I said, if you have questions, these are the FAQs, they're updated regularly. And so that actually made it a lot easier for people to just go in, have a look at all the key questions they had them categorized. And just even having that level of attention to detail was something that a lot of the investors I spoke to really appreciated, because they could see how much I was thinking about the raise. And, you know, a lot of them came in with the view that if you're thinking this seriously and you're so organized with your raise, I'm going to make that stab that you're probably this organized with your business as well. So I hope this was helpful.
Yeah, fantastic. Thanks, Sarah. And tell us about Giant Warm Intro. Did you do it last year or the year before? I don't remember.
It would have been 2 years ago, because it would
Yeah.
have been about 2 years ago. And yeah, for me,
in the meeting, when you were meeting with your investors, tell us a bit about how you got the most out of that time.
Yeah, it was really getting the feedback, I guess, because I when I was pitching them, I told them a bit about how the raise was going and like the initial conversations I had, how much I had raised. And a lot of it was really, I found, to be very honest, it was really interrogating my business model, which I wasn't expecting, because at that point I had 4 years of revenue, I had 4 years of experience that was still very much kind of digging as to whether, at least for one of the conversations, was digging a lot about how the model worked. But that ended up being extremely helpful, because that really informed what my FAQs were, because it made me realize, okay, what are the things I'm not explaining clear enough? And then it was through those conversations that I was able to get that feedback of, because you don't have that pure tech product, you should consider speaking to angels. And so being able to have that feedback early up helped me kind of reframe and re-strategize how I was going about the raise as well. So I found that really helpful. And one of the people I spoke to, I ended up chatting to quite a bit. One of them was Black Nova, actually, and they ended up making some introductions for me after the fact. So even when you're in Giant Warm Intro, even if the investor isn't the right fit for you, the network, everyone's so happy to help each other. So you're able to network through there as well.
Yeah, and I've heard that a lot. You know, the meetings that are set up, often it's just the first intro point to a sort of relationship that you can then circle back with over time. Absolutely. Yeah. And that you'll hear a lot about that. Community is kind of everything. So a couple of questions before I move on to Cheryl. Oh, non-core revenue. This was the one I could probably answer pretty quickly. So the question is how to deal with non-core revenue generated in the entity, for example, SaaS play, but you're still taking professional services revenue. So you see that a lot. That's pretty common. What a VC is interested in, or an investor is interested in, is the technology and the business model around that. Not so much how you've supported the business to date, or, you know, when the, you know, how that will support it and the tech product will take off. It's not uncommon, but they really will just be interested. They'll understand that there's legacy revenue, but that's sort of less interesting to them. It's really all about the growth opportunity and the capability of that tech product to grow. So I hope that is helpful. And there was another one about thoughts on securing pre-seed from someone like Antler, and will it make raising a seed round more difficult? No, I think that Antler's great. You know, that it's a great program, a great group, and they'll probably be able to introduce you to other investors.
Can I just chime in there, Sarah?
Yeah.
I think maybe it's worth just clarifying that historically there have been challenges. I think that the challenge that is experienced by founders whenever they've raised prior amounts of capital, like any accelerator or any other kind of funding source, is just what the ownership stake looks like for the founder by the time they're doing the next round. That is the issue. It's not who did you get the money from or which accelerator did you go through. So it's easy for founders in the earlier days to be less mindful of their ownership stake and how they're protecting that over time. And I'm sure Jace has got kind of stories about how that's unfolded through their rounds. Like that's utmost importance, and later investors want to see that incentivization still core for the founder through that ownership stake. So being aware of the terms for any kind of investment you're receiving, Antler, StartMate, angel investor or otherwise, be on the lookout for anything that feels egregious. Like you shouldn't be giving away, definitely not more than 20% in any of those early rounds, but for those pre-seed rounds, keeping it as low as possible. And I'm sure Cheryl can kind of add to that perspective as well.
You absolutely nailed the equity side of things. I might just add one thing that I think sometimes Antler not necessarily perpetuates, but the reason you're asking the question, one thing that we do look at is how long the founders have known each other and whether that's a good founder dynamic. And so Antler does put founders together, and I think they do a fantastic job of that. However, statistically, not 100% of those founders are going to jive. And so like any accelerator, a good chunk of them don't work out. And I think we look at founder behavior and founder dynamic as one of those things. And so just the nature of the original Antler generator program of putting founders together with very little time of knowing each other has contributed to that dynamic. They're operating more as a fund, is my understanding these days. And so if you're coming to them and getting money, and because you've known your co-founder for a while and you've met them together and you've worked together, then that's less of an issue. It's just that the original generator program put founders together, and that was something that we would look at and say, perhaps we might not want to back a founder team that hasn't known each other for that long.
Great. Thanks, Cheryl. The question that I'm going to give to you as well, because I love the question. What is the max that can be raised for a pre-seed?
Sky's the limit, mate. Like what Milk Run raised like a 74 million pre-seed round. So there is no max. It comes down to founder equity and like Lauren said, and amount that you need. So if you look at what you need to get to the next milestones that change the value of your business, and you need 74 million, then go out and raise 74 million. You may not be able to. So then the next constraint comes in is, well, how much can we raise?
If you're a third-time founder with 2 exits, raise 74 million. If not, maybe.
Exactly. If you're not able to because you don't have those type of credentials, then you need to factor in, well, how much can I raise? And if that meets my what I need to get to those milestones or not, maybe you adjust your milestones. And then you look at, well, how much equity do I want to give away? You might be able to raise 74 million, but you might need to give away 50% of the business, which comes back to what Lauren was saying, is that we do look at that. And so it's a balancing act. There's no min or max. You could raise $1 if you can make your business work on $1. Awesome. There's no min or max. You got to factor in, triangulate and calculations on the whiteboard.
So before I go on to asking Cheryl about what they look for in founders and in what's a good deal, I'm going to give you another book to look at. But this really helped me when I was getting across venture capital. Oh, can we see it? No.
Venture Deals.
Venture
by
Deals.
Brad Feldman.
I'll take a photo and send it to you guys. But it's called Venture Deals. And it just gets you across how to structure a deal, how deals are put together, and it's going to answer some of these questions here for you, like what valuation, how much should I raise, how much runway should I look at, and really how to put together a deal, because that's something I would recommend you really get comfortable with and really understand for yourself, because you're the only one who can really do that for yourself and understand what you need for your business, and go hard after it. So Cheryl, I'm so excited we've finally got to you. So what do you look for in a founder and in an investment, a good investment at Aussie Angels?
So just to be clear, Aussie Angels is not a fund. I run an angel syndicate, and that syndicate is called Mack Ventures, very creatively named. So you can come and find me as an investor personally. That's what I do. I invest personally, and I have a syndicate that invests alongside me when I make a decision to invest. So I invest at this stage, primarily at the seed stage. What that means is that generally the company has a little bit of traction, does not have to have revenue. In fact, most often they don't, or they have a negligible amount, but they do have to have a product in market and users. Because when I look at traction, that's what I look at. I look at what is the early evidence of what we like to call product market fit or problem solution fit. And that early evidence often comes from users of your product or even your solution. You may not have a product, but you have a solution that works and is manual and you do a lot of background work, but it's being used to solve a problem, then love it. So I don't always necessarily need to have revenue, and I don't always necessarily need to have a finished product. I typically invest not personally, but as a syndicate, we typically invest between 100 to 200K. Typically the round size, the amount the startup is raising is about 1 to 5 million. That's because when I'm investing my 150, 200K, I'm not taking up the whole round. There's usually a lead investor who has set the terms. I'm not particularly great at that. One of the questions that came through on the chat earlier was, how do I set a valuation? And the answer is you go and ask the market of investors. If you come and ask me, my answer is going to be, well, what is somebody else who's better at this game? What have they said? And then I decide whether I agree or don't agree with that valuation. Typically, although speaking of valuations, typically the valuations are between 5 to 20 million AUD when I invest. What else do I look for? There's two main things that I typically look at in depth when I look at an investment opportunity. The first is the founder or founders. And so as I was talking about earlier, the founder dynamic is important to me. Not just that, but we look at the founder's background, their experience, their skills, how they work together, how long have they known each other? Are they a good fit for this market? So we look at founder market fit. Are they chasing something that they're super passionate about? Are they doing this work? There's a number of factors that I look at on the founder side, some of which are more art than science and hard to articulate. And the other one is market size. I look for a really big market. There's a question somewhere I saw, does it have to be global? No, it doesn't have to be global. But I am looking for a really, really large market opportunity. Most often that ends up being global because it's hard to build something that has a really large market opportunity just in Australia. But I think I have seen it. Can't name it off the top of my head. Not to say that if it didn't come along that I wouldn't invest purely just because it's Australian only. So those are the two main things that I look at and we'll do a lot of my DD on. There are other investors that don't care about market size at all. So it's just worth noting that we're all different. We all have different opinions. We all have different theses on how to invest. That's just how I do it.
I think that's something that is also a nice trick to have up your sleeve when you're raising, is understanding what drives the investor who you're pitching to. So we are a fund, venture capital fund. So we actually pitch all the time to investors. So people invest their money into us and we promise to, make really good returns for them. So understanding what we kind of look at and what the limitations around that might be, and understanding that it's, often the no is not personal, it's just not within our, very sort of tight criteria. And so understanding the drivers behind each investor's or investment type is really important. So there's a question here, Cheryl, for you from Davis, which is interesting. Do you ever invest into something like Virtual? For example, if we aim to raise a seed via a platform like that, would angels or other funds put their money into the project via the platform?
So just to be clear, anyone who is deploying private capital into a private business is an angel investor. So all of the people who are investing via Virtual into private businesses are private citizens and they are angel investors, whether they call themselves that or not. I would classify them as angel investors, which means we have a lot of them, which is really fantastic. So yeah, just to be clear, they are, if you raise via that platform, you are raising from angels. Would I, or do I ever? I mean, it's not out of the question. I don't like blatantly cross it out and say, no, I'll never invest on virtual or equitize. I've found traditionally that platforms, particularly virtual, is more consumer company focused. And I do invest almost exclusively in B2B, not just B2B SaaS. I know there's a question earlier that, Australian investors are very focused on B2B SaaS. You are absolutely correct. And I'm sorry to perpetuate that. But I am pretty exclusively focused on B2B. So when the majority of deals that come along on those platforms tend to be consumer focused, it just doesn't make sense. The other thing for me is that I need to look at, like I said, I don't set terms. So when I look at a deal, I look at who has set those terms. And often on those platforms, the terms aren't set by a lead investor that I would love to follow. So it's not that I wouldn't ever, if the right deal came along. In fact, I would have loved to have gotten into ZeroCo that was led by SquarePeg. And I also would have loved to actually invest in Virtual itself, but they also send a lot of emails. So I tend to miss the ones that I actually would have liked to have gone into because there's just a deluge of other ones. But they do a really fantastic job of getting some really bought in customers who are also investors. So great platforms, not crossed off my list. I haven't so far. Actually, I think I've done one.
I was just going to also say I've done a couple as well. They do definitely have some great B2C ones because the model is suitable for those crowd campaigns. Like you want to, engage the crowd. But I think Virtual has actually done a really great job on the B2B side of things. So one of their, it was called Thrively or something like that. I actually can't remember the name off the top of my head. Yes, sorry, Thriday. Thank you.
Yeah,
all good. So that was one of the first rounds that occurred through Virtual where I think the VCs were investing alongside through the platform rather than running a parallel process. So if anyone, I think if anyone's cracking that kind of mutual side of things, I would say that the understanding of crowdfunding in the Australian venture market is still fairly poor. It's got a bad reputation from a good 5 to 10 years ago, as opposed to a more current view on what kind of deals get run through the platform and the global success of equity crowdfunding platforms. But it is right for a particular kind of business, and they do have some great businesses to invest in, but you just have to check the suitability of running a campaign through it for yourself.
Yeah, great. Now, I think we've answered all the questions in the chat and we've kind of gone through, the main points that we wanted to make. I just wanted to go around and ask each of the panelists, what are your top 3 tips for founders raising in this environment right now? Everyone on this call either maybe they're currently raising, they're thinking about raising. So maybe think about, 1 or 2 or 3 tips, or even just one thing that you think, I wish I had have known when I set out to start raising, or I wish the things I wish all pre-seed founders or early stage founders knew. And we'll start with Jason.
Surprise question. Thanks, Sarah. Brilliant. Kidding.
I know how much you love to talk. I know you can answer this.
I got it. Yeah. So I think this is the biggest tip in general, but it's also the biggest tip in the current market is building quality relationships. I think it's already been touched on, but I think in this current market, it's more true than ever. So for me, the biggest weakness I see with people capital raising is they don't know enough investors. They haven't spent enough time investing in the relationships, and they just aren't aware how important the lead investor is. And so the first person, say you're raising 500 grand, the first person that says you can have 50 grand or 100 grand, they're putting a huge amount of trust in you. They're staking their reputation on you. They know other people are going to follow them. So just investing in those relationships, working really hard to show that you're trustworthy and that you deliver, and and that you're backable. And that would be my absolute top tip. Like going directly with that is having an investor CRM in place and understanding what an enterprise sales process capital raising is. So even though you got to do your pitch and your data room and everything like that, the actual process of having, I've got a CRM tool in the toolkit, but when you first, just say you want to raise $500,000, you need to have 10 times the amount of demand in the beginning, and then you need to qualify them down through that 3 to 6 month period. So by the time you're actually raising, you want to have demand from quite a lot of investors that already know you before you actually open up your round. Sorry, there's a little party going on over here. Hopefully you can't hear that. So yeah, so building trust, but really running like a powerful enterprise sales process with a big top of funnel work, qualifying the investors, and then opening your round up when you feel like you've got like a lot of momentum and demand on the investor side.
Great, thank you, Sarah.
Yeah, mine echo what has already been touched on as well, and kind of follows on from what Jason was saying. But I think putting in that time to qualify potential investors is one of the most important things. Really figuring out what is it about them that makes them the right investor for you. Because I think that's something that people don't necessarily think about all the time, of like, will they actually add value? Will they understand your vision? Putting in all that energy to do that will save you a lot of time, because it'll just make your meetings more effective. And as a founder, time is probably not something that you have a lot of. So being more efficient with that is really helpful. And the other one I would say is, not to take things personally, and to kind of try and, I mean, it's very hard to do, but try and detach yourself from the outcome of the raise, especially in this market. Like even more so than usual, it is not reflective of you or your business if you're having trouble raising. And I think making some space throughout the raise process to make sure you're taking care of yourself and your mental health is really, really important, because it is an extremely difficult thing to do. And especially at early stage, to some degree, they are really backing you as a founder. So it makes that ability to detach yourself even more difficult. So really creating that space, trying not to bank everything in your life on the raise as well, and making sure you've got good people around you.
Can I add one thing before we go on? I totally agree with that, but there's one thing that early stage founders aren't good at across the board is asking investors for money. You have to actually ask them, will you give me money?
Yeah,
Or if you haven't quite raised yet, like just before you're qualifying them, are you investing right now? Have you invested in 2023? Do you invest in my niche? When I open my round, do you want me to pitch you? You must ask these questions. And it's really hard because sometimes you don't want the answer and you're so scared about being told no, or like crossing them off your list and all that hard work you got to do. You must ask those questions, and you must actually at one point say, will you sign this document? I'm going to send it to you. You sign it. The thing that happens after that is your money goes in my bank. I'm not trying to be too facetious, but like it is hard. You must, if you've never done that before, give yourself a goal by the end of next week, ask those questions and start qualifying your investors.
Qualify, like don't waste your time on investors who you don't have that time to waste. Just a hot tip, one of the things we look for along the lines of that is this founder ready. You know, one of the things in Giant Warm Intro, I'm vetting all the entries right now, and it's a different criteria to getting investment with Rampersand. Giant Warm Intro is different. But one of the questions is this founder ready to raise? And the only way I can answer that, looking at the pitch decks you've submitted or, you know, the information you've submitted, is if you have an ask. Yes, we're raising 500,000 for this. We're raising, you know, and you have that slide with that ask. So, you know, and maybe it's okay if you're not ready for that. Giant Warm Intro is totally fine if you don't have that ask ready yet. But that's something just to think about there. Lauren, top tips.
Like I've got a bit of an avalanche of advice coming out of me, so I just need to channel it in the right direction. The other thing that was a bit of a backed onto the points that were just being made as well is make sure you maintain some sense of the deal momentum. There's the worst thing that a founder can do is actually like let the air out of the tires and just drag the process along, because I can tell you, even I'm always trying to keep founders' interests at heart, but I've even been in processes where the founders really let themselves down because the weeks drag on and suddenly even I'm not excited anymore, even though I was their biggest champion. And it doesn't mean that investors are fly by night. It just means that, you know, you've got to capture that momentum where it's. So that was my free tip. That's not the one that I want to talk about. I think that the real tip is, you know, at that early stage when you're considering raising funding, first and foremost, I would just make sure you're still pushing a bit of hard work back onto you to test whether there's, you know, okay, I want to raise money to do this. Is there any other way I could achieve this outcome or achieve this growth without just pulling money into the bank? Like, what are the cheaper, faster, leaner ways to test my assumptions here, because that's actually what you're doing. Borrowing money to test assumptions is not a good idea until you have some sort of more concrete things underlying the premise of the business. So test and draw on other resources before you can. Get things for free if you have to. That's like the other way of paying for them. But once you have identified, and maybe also, rather than spending all your time asking investors for money, make sure you're asking customers or potential customers for money first. They're both equally difficult, but one could actually set you on a trajectory much faster and more sustainably. So there's that aspect of it. And then I think flip to that, I guess that sounds like I'm encouraging you to not raise money, which I think there is a healthy dose of that in my advice. But the value of a pre-seed round of some very strategic and well-connected super connector angel types, investor types, can be an incredible thing for your business. And it may be the last round you ever need to raise. If you can think about that small capital injection up front as being the amplification of what you're trying to do, and you're drawing on other strengths of theirs besides the capital. The capital is their incentive to help your business succeed. So that's the best kind of money I think you can take. There will be businesses that need to move beyond that to get larger rounds of venture capital funding, which will have greater expectations of return. But in this earlier wedge of angel and pre-seed and seed stage funding, that can get you off to the races, and you can have incredible outcomes, with all your champions behind you benefiting from doing that as well. So think about your angel investment or your pre-seed or your seed round as the collection of champions that you want around you to be able to achieve what you want to achieve. Don't think about it as a step to the process of just getting more money in your bank account. Okay, that's mine.
And with the last couple of minutes.
Oh, sorry, I just thought there was one more thing. I don't think we've said it, and maybe we have, so sorry if I did miss somebody saying it. Things like Airtree Explorers, Startmate First Believers, and of course, Aussie Angels, network of syndicate leads, like these are the kinds of champions. There are sources of these groups of people who aren't just willing to invest money in startups, but bring incredible experience operationally, as founders, as other investors alongside. So look at those sources for those champions.
Awesome. Thanks, Lauren. And Cheryl, top tips.
Yeah. The other panelists have said some amazing things. So I'm going to give you some uncommon insider knowledge. Two things. One, time kills all deals, and investors at the end of the day are irrational, emotional people. Why does this matter? Because you can leverage that irrationality to create FOMO, and couple that with time killing all deals means things like make sure you move fast and get people to commit. If they're ready to write money, let them give you money. Don't make them wait, because the longer they wait and the longer time you give them, the longer time they have to get to a no.
Yeah. You can create FOMO. Hey, Cheryl, you have to create the FOMO. You almost have to tip it up and force the energy. It's a tricky skill, but it's pretty important.
Exactly. So investors at the end of the day are irrational, emotional people. You can create FOMO because of that, which is fear of missing out, which is investors don't want to miss out on a really good deal. So if you tell them that some other investor is in, don't lie, but if that's the case, leveraging that. Also leverage urgency. So things like, hey, I'm going to close on this date and you have until then to decide, need your answer in. We're getting to the end. On
that, Cheryl, I closed my very first pre-seed round 3 times, and each time I closed, I didn't get the whole amount. So I got something, and I opened it again and ran it and closed it, because I'm like, how the hell am I going to get these people to sign these documents?
Exactly. And we've all got egos, and we all think the world of ourselves. And I'll be honest about it. I like to be told that, I'm valuable. So leverage that as well. Investors are still human.
I love that. And all the investors I've met and talked to, they really care about building the ecosystem. That's actually a real driver for them, and they're really passionate about the space. So leverage that. We are over time. Thank you, everyone. Thanks the panel for joining us. We will send, there's a question about con notes versus safe for pre-seed. That's probably a bigger question. You can follow up with
either or are fine. Don't worry about it.
I think we need more detail. That's not enough of an answer.
It's in the toolkit. Just message
Yes,
me,
in the
Jason at
toolkit. That's what I was gonna
cakeequity.com.
say.
I've got all the info you need.
And I uploaded a picture of that book I was talking about. But thank you everyone for your time. Sign up for Giant Warm Intro. Email me if you have any questions, or if you want an introduction to any of the panel, let me know. LinkedIn is also there for everybody. And we will see you at the next one. Thanks.